Okay, so now I want you guys to look at a picture here. This picture is a certificate of a bond. So as we mentioned earlier, bond is a legal agreement between the borrower, which is a company, and the lender, which are the investors, okay, or buyers of the bonds. If you buy the bonds, basically you are giving the money to the company and expect interest and the principal paying back to you in the future. So it's like a lending instrument. So what financial information can you extract out of this certificate of bond? So this is a very old bond, and it was issued by the Pacific Railroad Company when they tried to build railroad across the west coast to the east New England area in the 19th century. So you will look at some numbers here. So you will see a $1,000. That is the face value of the bond. We also call it par value of the bond. So that means when the bond matures at its due date, the investor will present this piece of paper to the company and get $1,000 cash back. And when this bond due, the payable date is May the 1st, 1895. So that's the maturity date of the bond. And this bond must be issued years before this maturity date. What other information can you see here? You will see a word 7. 7 is the coupon rate. For the rest of the class, I will just call it a coupon rate instead of a coupon interest rate because I don't want you guys to get confused with coupon interest and nominal interest rate. So this 7% is out of this $1,000. So 1,000 times 7% is $70. That means each year the bond will pay investor $70 as interest. If you look at the small pieces of papers here, these are called coupons. And each coupon has a value of $35, which is half of the $70 annual coupon payment. So this bond is paid in interest on a semi-annual basis. So if 1 year $70, then 6 months should be $35. Okay, so it's a semi-annual coupon payment. And also you will see this 50 and 50 here. These are under special contract, so this is not part of our analysis. Anyways, although nowadays bonds are not treated like this, you don't have an actual piece of paper for it. The bonds are more likely to be treated electronic. Okay? Still, we have the same features like semi-annual coupon payment, like you are given an interest for coupon rate, and you also have a 1,000 par value. Well, $1,000 120 years ago is worth a lot more than 1,000 today. You know that, right? At that time, a officer in the military got paid like $25 per week. Nowadays, it's a much higher rate due to inflation. So here are the financial terms in the contract in summary. The face value is always $1,000 as 150 years ago as it is now. But you also have a payment, and the payment is made periodically. I did not say it's made annually because the payment could be made semi-annually, which means it's delivered every 6 months, or quarterly, every 3 months, or monthly. So not necessarily annually. You also have a coupon rate, and a coupon rate is an annual term. You have to remember that. If you have a 7% coupon rate, that means during the whole year, the coupon payments is $70. Although you may pay the $70 twice a year, split it and pay the $35 like that, or even in a higher frequency. But the sum is $70, and that's determined by the annual coupon rate. You also have the frequency of payments. It could be made semi-annually, could be made quarterly or monthly. You also have a maturity date, and this basically determines the time to maturity, how many months until the bond matures. And definitely you have an issue date. That is when the bond was originally sold by the company. So what you don't have here, what you don't see in the black and white contract is a bond price. you don't know how much you should pay for the bond, right? There's no bond price saying this is a $1,013 or $987. No bond price. It's really determined by the market. Okay, so you don't have a bond, the fair value of the bond. You have not estimated that yet. And you don't have a required rate of return of the bond. And the required rate of return in this chapter is called yield to maturity. Okay, for bond, required rate of return is yield to maturity. And that's determined by many things: the cash flows of the bond, the interest of the bond, and also the maturity of the bond, and many other things. So you use this required rate of return to discount the cash flows. So the cash flows are the coupon payments, are the face value. You put a discount to get the present value of it. And this is something we learned in chapter 5, time value of money. If a $40 coupon payment is made next year, you know if you discount it, 40 will be worth less in today's dollar. If you have a $1,000 delivered 20 years later, then if you put a discount, then you get a less than $1,000 for today's dollar. And you don't have a settlement date. You don't know when the bond is traded. If you trade it today, or if you trade a year later, or you trade 3 years later, the bond would be at different prices. Okay, so at a different settlement date. Settlement basically means the time you finish your transaction, the time you buy or sell the bond. So at settlement date, that determines the time to maturity. How many years left until the bond matures? If you trade the bond, let's say today is the issue date, and 10 years later is the maturity date. And if you trade the bond 1 year later, then your time to maturity would be 9 years, right? 10 minus 1. The basic principle to get the value of the bond, just like other financial assets, to get its fair value, we just discount the cash flows. We just discount the cash flows to today's value or present value. Okay, so the bond is a financial instrument which will give you cash flows. The cash flows will be represented by the coupons as well as the par value. And the interest rate is not the coupon interest rate, very important. The interest rate is actually yield to maturity. The interest rate is inversely related to the present values. So the higher discount rate you put in here, then the less value you would have if the cash flows are the same, right? If cash flows is the same, well, definitely it's the same, because if you look at the bond contract, you have a fixed amount for each year's coupon, you have a fixed amount for the par value, which is 1,000. These cash flows never change, but the discount rate could change according to the market condition. And if you have a higher discount rate, the value would get lower. And you can use a financial calculator to get the estimation of the bond price. So the components on your financial calculator are the following. The present value is something you need to solve for. That's the bond price. And the future value is always $1,000 as it was 150 years ago, as it is now. The payment is the coupon payment made each period. Okay, and the coupon payment is determined by the coupon rate. As I said, don't call it coupon interest rate, although that's the official name of it. I want you to call it coupon rate, just to distinguish the coupon rate from the interest rate which you use as a discount rate. And the required rate of return is the discount rate or the interest rate. Basically, this is the yield to maturity. And N would be years until maturity. And it's very important that you need to adjust for the payment frequency.